Okay. The lesson is a cautionary tale on how not to play the futures market. So I ended up, I figured 77.50 is a good spot to enter, and I started entering 77, or rather 77.40. I don't remember the exact number. And I'm stuck now. I got 4. I don't want to have 8. It's too risky with the Fed coming up. Even 4, I can get really badly burned. And the same go. Well, the S&P, I did intend to have more than one, but I bought this one at just about 480, and then it fell, so I didn't buy another one. Wait and see what happens. Anywho, all right, there's that. No, go away. What else is happening? Oh, petroleum status. Let's take a look at that. Attendees, go away, attendees. Well, why is it not going back where it belongs? Oh man, I'm so frustrated. Huh? Wait, there was an X. I can make an X. Haha! I figured it out. All right. I don't even know if you guys can see that, but the little pop-ups I get where I can see the questions and stuff. Anyway, petroleum status report. What is this weird thing? Well, what an odd assortment of people. The world's richest families. Oh, I was like, what is EP? I was trying to think of what they all have in common. I'm like, I know most of them. The common factor is money. All right, so hopefully the 1 o'clock report is out. U.S. crude, blah, 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 December 9th. And what's today? Today's the 14th. That's the 9th. Sounds like a long time ago. No, it was Friday. I swear these things used to be dated on Sunday. So many things that were true for decades before COVID got changed, and nobody makes much of a fuss about it, but I don't like it. I like things to be where they were. Anywho, refineries 92%, gasoline production averaging, blah, 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 who cares? Okay, oil imports average 6.9 million barrels a day, increase, a lot more imports. That's important though. See, we usually get upset about the decreases, but here's an increase that puts 7 million extra barrels into play. Over the past week, crude oil imports average 6.5 million barrels a week. Blah, 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 blah. All right, commercial crude inventories increased. Wait, what? That is not at all the number I saw earlier. What the frick? Did I have bad information before? And if so, why would oil be where it is? Oil. There. Petroleum status report, crude, 10.2 million. Oh, it was the SPR that was minus 4.7. Silly me. I read it wrong. It didn't say plus here, and I read minus 4.7 and thought that there was a 4.7 million barrel draw. This is a massive, massive build then. This is a 10 plus 4 plus 1. You do have to factor in the SPR. So even so, though, it's still like 6 or 5.5. So it's 5.5. It's still like a huge, huge build in crude. I don't know what people are thinking. So I'm pretty happy about my shorts now. Yep, 77.57, whatever. All right. Frick. Where were we? Oh yeah, the report. Right. Okay, so I'm sorry, I read that wrong earlier and wasn't thinking it was such a big build as it is. You can even see in the net, you see the net total of everything, including the SPR, is 04 to 13. So basically a 9 million barrel net build is pretty serious. They're talking about imports increasing. I don't know what the frick they're talking about. U.S. crude oil imports averaged 6.9 million barrels per day last week. Net imports. It says 2 here. Oil imports, net imports, total -2. I don't get it. U.S. crude oil imports averaged 6.9 million barrels per day last week. Where? I guess somehow they're saying 6.9 minus 4.3 equals that somehow. Weird. Anyway, that's why you gotta, you can ignore this and just go by week to week. So basically, same as last year. This is what you look at. Same ish as last year. Actually, there's more total refining input, but that makes sense because we had COVID last year. We don't have COVID this year. Refining capacity is up 5%, therefore more is being produced. Gasoline ends up being, but we're producing less gasoline. That's interesting, right? We're producing less gasoline. We're producing much more distillate, well, 10% more distillate. And the biggest deal is, of course, that we look at, here's the biggest thing. Last year, we exported net petroleum products 2.7 million barrels, which is by itself huge, though. It's like 3 million barrels a day, 21 million barrels a week. The entire day's quote, I'm going to say quote use, because we don't use that much oil. We export 3 million out of 19 million. 15% of this oil is exported. So we're not using it, and they always talk about how much oil the U.S. uses, and it's not a real number because we don't use that much. And now it's not 3 million barrels a day, it's 4.3 million barrels a day out of 19. That is 20%. 20% of the oil in America is exported as a petroleum product. All we do is refine it and send it out of the country. 20%. And I'm not going to do this every month. I mean, we have this discussion multiple times. It's there's a war. So to some extent, there wasn't a war 2 years ago, and there wasn't last year. There wasn't a war in December, but there's now a war. So yeah, we're helping out our allies by sending more oil out of from the U.S. to other countries. That is a net help to the people who are dealing with Putin's bullshit. It is what it is. Okay, so but the point is, if you look at the reality of the situation, when people start telling you about the U.S. demand for oil, it's 20% less than the number they're quoting, because we're sending 20% of the oil out of the country. It's not our demand. So our demand last year was, I don't want to make a mistake, so I'm going to do it this way. So we got 21,250 per day, minus 2719. 2719 was exported. 18.5. You got to remember that. So last year was 18.5. Now it's 19,794, a much lower number of total production, minus 4,312. 4,312 is being exported. 15.4. So it was 18.5. So the actual consumption in the United States from last year to this year went from 18.5 million barrels per day that we were actually consuming here, and now it's 15.5, 3 million barrels less. Our use of oil has dropped 20% of petroleum products. Our use of petroleum products has dropped 20% since last year. That's a lot. That is crazy, huh? And yet you will read article after article written by analysts who don't deserve to be even allowed to put a pen to paper. And not that they do, because there's no pens and no paper anymore. But, you know, they just, I used to get really frustrated because they would call me to interview me. These newspaper people and magazine people would call to interview me about oil. You know, when I was in New York, I used to be on TV a lot more. So, you know, they'd always be calling me to get my quotes and things like that. And they would call me and they'd ask me blah, blah, blah about oil. And I'd say, yeah, but are you looking at this? And I would do exactly what I'm doing with you guys. I'd go over this with them. I'd say, look, you've got to look at this chart. You've got to understand what this means. And it's like talking to a freaking 5-year-old. I mean, they just do not understand because they've never had their view challenged before. You know, they never think about what the mechanics of what this thing is actually doing and what these numbers actually mean. But you cannot take these numbers at face value. You got to look and dig into it and think about what this is really doing. Meanwhile, finally, gasoline is now lower than last year due to the incessant lack of demand. Gasoline is generally a little bit lower than last year. Diesel is still crazy higher. And oil itself is back around the same price, although now it just went up from 71 back to 77, which I don't think is going to last. See, 77.40. Now, what am I supposed to do? Because I added more. I only wanted 2, and I added 2 when it went too high, so I would raise my average. But now when it comes back to 77.41, I want to get out and get back to 2. So we'll see. I guess I can put a buy in here. What the hell? It'll alert us when it starts falling. Anyway, so that's that. Waiting for we got 40 minutes until Mr. What's his face Powell starts talking and the Fed does their thing, and chaos shall ensue. It's so funny. It's like there's such a narrow range of things that could possibly happen, and everybody's acting like it's like going to be a world-changing event. I used to have a remote. Oh, here we go. I'm going to prepare. You know how usually I'm like scrambling to figure out where everything is at the last minute. So now I'm going to actually like go to the news. In theory. Yep. Wants me to watch Puss in Boots. No, thank you. Let me see now. Ugh. Nope, doesn't help. I still can't figure out the stupid room. I never use this TV, and it's got an Amazon stick, and my living room's got a smart TV. And this one in my office I never use except for like if something's up. Recommended apps for you. No, I don't want an app. I want the freaking news. I thought I set it up as like a favorite. Find live my stuff. Live. Would we consider this a live thing? Breaking news, Bloomberg, yay. Okay, found it. And loading. I miss my TiVo. Yeah, I like my TiVo much better. Oh, it's Al Gore. Okay, let's assume this is correct. Oh, everybody's getting so old. So what happened? Never filled my thing, right? Okay. So let's see what's up. Everything's good. Let's talk about other stuff. Now, so we've been doing some portfolio reviews. That's always fun to chat about. That was here. And we have got like hedges up the ass. So what is this? This is the money. Oh no, this is a short-term portfolio. Oh, okay, we reviewed that first apparently. All right, so here's a short-term portfolio. We got our TZA hedge here, which is the 40 calls, and we're only at 30. Well, we were at 32. I don't know what we're at now, but this was on Tuesday, yesterday. So we're at 32. So we have the 40-70 spread here. We've got these UNG puts are gonna, well, eventually they'll expire worthless at long term. We have our coffee longs here. I feel good about that one. We have our natural gas here, and that one's at the money, so I feel good about that one. We have our Dow shorts. Those are not doing well, particularly. Well, no, they're not doing well. They're down 40,000 bucks, so they're not doing well. But it's a hedge, and also it doesn't count for the fact that we've been using this hedge to sell short-term calls, short-term puts. Sorry, but at the moment, in this particular quarter, we've been doing this since July. In this particular quarter, we're not selling them because that makes us more bearish, and that's all it takes. Like usually, we sell 20, 25 short puts against this position. Those short put sales pay for the position, which originally cost us $120,000. So it used to be $120,000, and we certainly sold a good amount of short puts here. And what we'll do is if we do get a nice dip in the Dow, we'll sell short puts again, and we'll make our money back. We'll start getting money. Plus, this will go more in the money. If it doesn't go our way, we'll either shut it down and take the loss, or we'll start selling puts again, one way or the other. Depends how confident we are. But that's one of the easy ways to adjust your portfolio very quickly, is to have a position like this. We call it a mattress play. And the idea is that, and it's because you're engineering a soft landing. That's what you're doing. So, we've always got the short put position. And if the Dow sinks below a certain level, that pays off in full. In this case, it would be 50 times 50 is $250,000. It's currently net. It's currently net $60,000. Oh no, sorry. It's currently net $80,000. So it would triple from where it is right now. And we have the ability to generate. Well, let's take a look. Trade. DIA. So let's say we were more confident in the Dow. It's a 350. Oops, gonna move that. Okay, so it's a 350-300 spread. So if we wanted to, let's say we felt more confident. Currently we're at 343. So let's say we sold the 320 calls for 525 or 530, whatever. So let's say we sell 20 of those. We're not likely to get in too much trouble selling 20 times 535 is $10,700. All right, so we could collect $10,700 for 90 days. All right, against this spread, 350, 300, 2024, and it's the 320 put. So obviously, if the Dow does slip, we can roll the 320 puts to a lower strike of June, and then we can roll to a lower strike in September and a lower strike in January if we have to. We can keep rolling them down. We can change the position. So 20 short puts aren't really going to get us in much trouble, but we raised $10,000. Now, originally we took this position in July, so we had 500 days, let's say, to trade. So out of 500 days, if we every 90 days can get $10,000, it means we can collect $50,000 back. It was a $120,000 spread, and if we can make $50,000 selling short puts, then the net of the spread becomes $70,000 on the $250,000 spread. That's probably about where we are at the moment, as if we went back and figured out what we sold. That's fine. I mean, it's fine for now. And at the moment, but like I said, all we have to do is not take the $10,000, and suddenly we're much more bearish, right? Because there's no breaks on the gains we can make. And that's what I like about those kind of trades. They're very adjustable and adaptable. And of course, in reality, although we went from 48 to 28, right? The net of this spread was what? $24, right? These guys are still 28. That means if I sell these for 28, I can now move to a, let's say, 2025. So what I say we're pulling like $24 up. Oh, 28, it's $28. So let's say our target is the same. If the Dow goes lower, we want to get paid. So the spread, now notice the spread in 2025 is only 34, 35. Let's say 35. So 35. And how much money do we have? We have $28, right? That means we can go to the, these guys are like 15 bucks. So let's call it 280. It's less than 15 bucks. So for net, no, that's only net $20. But for net $20, we can have the 350, 280 spread in 2025. Right? What do we say is this? Let's say 35, and let's say the 280s are 14. It just says 1572 though. But let's say they're 14. So 35 minus 14 is what, 11? No, 21. So we're cashing 28, and we move to another 21 spread, and now the 300 puts of 2024 become the short puts against this spread, although I would adjust it and move it and do some other stuff. But bottom line is you can see how that works. So we're recovering our entire net investment, and we get to play for another year. So we make $50,000 in the first 18 months. Then we roll it at no cost, not only no cost, but we'd be taking money off the table. We're taking $35,000 off the table. And then we've got another 4 chances to four quarters to sell 10,000 more and get another 40,000 off, maintaining the position. So that's why I like those trades, but they're really, they're just trades you have to manage over the long period of time. You have to make sure you don't let yourself lose the money on the main spread. So your net that you put into the spread, this net $24 that we put into the spread initially, you want to make sure that you keep it, and all you have to do is make sure that doesn't go below 24 before you make an adjustment. If this is below 24, it means this guy's lost a significant amount of money, right? If he's lost a significant amount of money, and he's 50% down, then all we got to do is keep a stop on some of these and shuffle them around a little bit, and we can take care of it. And then we've got a brand new spread for the next year, a wider spread in 2025, as it turns out. What do we say it was? 350, 280. So those trades tend to work out, and it's from the experience of, like, we developed the style back in 2006, 2005, because we wanted to, you know what it's good for? It's because in 2005, 2006, we thought the market was going to collapse, but it never did. So we came up with a strategy to say, okay, we're going to hedge, but we're going to hedge lightly. We're going to hedge variably so that we can quickly just take off the short puts, and boom, we're suddenly much shorter than we were before. You know, that we can instantly, like, make ourselves more bearish by making one tiny adjustment to these kind of spreads. And I always like that about those trades. And we call them mattress plays. All right, coin. So coin we like, and we love those guys, and I think they're going to do better. Did we not make the adjustment to coin? Nope, I guess I wasn't in the mood to spend money. Okay, fine. Because in the futures NAP portfolio, I just made adjustments to coin. Long-term portfolio made adjustments to coin. But here I decided not to. I am mysterious. Well, no, I see why, because we only just made this spread last month. All right, that's why. Because we only just put that spread in last month. And then the main hedge, of course, is SQQ. These short 70s, obviously, you know, we've only got 38 days. They're going to expire worthless. So we're going to make, and again, the same concept, we're going to make $211,000 because we sold these short calls. That's nice. That leaves us with 300 plus 500 longs in the 40-50 range, and all $90 shorts. So if you say it's like 45 to 90 is 45 times 800 is a huge number. 4500 times 800. Wait. Yeah, it is. It's 800. Wow. $3.6 million. So that's a $3.6 million spread. And the net of it, if you look at these numbers, is nothing. It's 1.1 plus, so it's 1.5, 1.6, and this is 1.6, so it's net zero. So a zero sum spread that pays $3.6 million if the SQQ goes way up. Now, what if it doesn't go way up? Well, then everything expires worthless and we have zero. Can't hurt you. Didn't sell any puts here. Call. So in other words, if SQQ goes down, we simply have zero. It's net zero now. I don't give a shit. That's why this is an incredibly beautiful hedge, strategically brilliant hedge, if I do say so myself. But the thing is, the logic of the spread, and again, this is because we're fundamental investors. Okay, there is a number I don't believe the Nasdaq is going to go below. I don't believe the Nasdaq is going to go below 9,000. We're at 44. It would have to go 100% higher to hit 90, right? That's math. And if it has to go 100% and it's a 3 times index, it means that the Nasdaq has to drop 33%. And the Nasdaq is currently at the Nasdaq is currently at 12,030. So we say 12030 times 0.7 would be 30% off, 8,421. So when I sell these 90 short calls, what I'm betting is that the Nasdaq will not fall below 8,421 from the 12,000 it's at now. I think we'll sell off, but I don't think we're going to sell off that far. That means these hedges are going to be fantastic. So we can go down, but as long as we don't go down lower than 8,421, we're not going to owe any money. But even if we do, we've got $3.6 million, and then our gains are capped at $3.6 million. After $3.6 million, we will owe the only thing we owe on, because we're covering 800, we'd be short on 200. These extra 500, these extra 200 here, we'd be short 200. So how much money would 200? So that'd be 200 and the extra 2 zeros. So $20,000. So each dollar would cost us $20,000. So if it goes to 100, we'd owe $200,000 back out of 3.6 million. If it goes to 110, we owe 400,000 back out of 3.6 million. If it goes to 120, 3 times, up 200% gain on the Nasdaq, and you divide that by 3, it'd be a 66% fall in the Nasdaq. We would owe 600,000 back on our 3.6 million. We'd still have 3 million net dollars, and that's a gain from zero on this hedge. All right, so the hedge isn't there to make money in an up market. That's what our long positions are for. The hedge, though, is zero cost now. If the market goes up, SQQ goes down, and all calls expire worthless, right? All the SQQ calls expire worthless, and we have zero. But we didn't pay for it, so we don't care. We have the same zero we started with. But if the market goes down and doesn't go down 66%, we're going to get about we can get up to $3 million back. We can get 3.6 million if it stays above 8,200. But even if it goes below 8,200 and drops another 20% below that to whatever the frick that is, to 6,500 on the Nasdaq, we're at 12 now. So you're talking about a 50% plus drop on the Nasdaq. We still would have $3 million in our hedge. It's just math, but for whatever reason, the people who teach options don't understand this at all. They don't do it correctly. They don't know what they don't know what they're doing. They make all these idiotic places. This very, very simple spread. You're just using the ratios to eliminate the cost of your spread. And also though, then it comes into the fundamentals. Then it goes back to like these charts we have, like today, I think, is this today? Okay. So then you're using, so then we've got our 5% rule and things like that. And that's how we say, I know this is too high, therefore we're going to go extra short here. And I know this is too low, and we were going to go, and we went long here. And now again, we're back to being short. And again, it's not just about the lines, obviously, but the lines tell me where the resistance is going to be. And then I say, okay, what's our outlook? What's the stocks position, so on and so forth. In the NASDAQ, most importantly, what's Apple doing? NASDAQ's easy. I really only have to look at Apple. If you look at Apple, you pretty much got the whole NASDAQ wrapped up in one stock. If it's going to do well, the NASDAQ will go up. If it's going to do poorly, the NASDAQ will go down. Now, there's other factors, and that's already happened, though. One of the biggest factors of a sell-off I always anticipated is I always said Tesla is in danger of dropping 60% and losing, I forget the number, but losing like getting close to $1 trillion in market cap, or 700 billion in market cap. And that was going to take a big chunk out of the NASDAQ. And guess what? It already happened. Tesla has gone down to whatever. Where are we? This was always my biggest concern in the NASDAQ, was it Tesla, Amazon, Netflix were at ridiculous prices. Look what happened in Tesla. So now they're at 500 billion, right? So they've lost, well, where were they? Let's see where they were. Yeah, they were at 400, now they're at 150. So I don't know what, I mean, 300 would be $1 trillion and 400 would be insane. It'd be 1.3 trillion. So they topped out at 1.3 trillion. They've lost $800 billion in market cap. And this was one of my main concerns for the NASDAQ valuation, was this. There was Netflix, there was a few other stocks, there was Amazon. I didn't expect Google to fall as far as it did. Google fell further than I thought. So, the Amazon, it's all things that we expected to happen if there was going to be a sell-off, because the valuations were ridiculous. And you guys heard me say this. I must have been banging the table on that fact this entire time, basically this entire 6-month period, getting around here. If you read back on my old articles from that time, every day I'm like, this does not make sense. The Russell does. I remember the Russell was where I really put my foot down, because the Russell hit like, I want to say 60 times valuation. I think the Russell was up around 60 times value or something insane. And it was completely unsustainable. There was just no possible way you can go there. The S&P was at 40 times valuation when we were up here. 40 times. It's not justifiable. The problem is that you have something better to do with your money than get back. What's 40 times? I mean, it's 1.5%, right? You're getting 1.5% per year when you're paying 40 times earnings. So what's going to justify that? It's idiotic. You have a million better ways to put money to work and make more than 1.5% a year. And again, I talked about this the other day. People you don't do the math overtly, but you do the math in your head, somewhere in your brain, because your brain is really good at math. There's so much of what we do in life is mathematically driven, but your brain is constantly calculating and formulating and so on and so forth. So you think you're not doing math, but you're doing math all the time, because it's like your brain's calculating the arc of a curve and where the ball's going. and your brain is calculating where to put your foot for the next step and how much you weigh and what your forward momentum is. And if you have to cease your forward momentum, where you should apply force, blah, blah, blah. These are all calculations that are happening in your brain all the time. It's not random. You're actually thinking of this stuff. Somewhere in there, the work is being done for you. And so even if you don't think you're paying attention to something, you really are. And it's one of those things, like something is bothering you and you can't put your finger on it. That's what it is. If you're bad at math and you don't think you're doing math and you see things like this and you say, I'm paying 40 times, oh, it's a great stock, I'm doing this and that. But then after a year or so, or after a while, you don't get the returns you thought you were getting, and you see other investments that are more attractive and other people are making more money on this and that. You do end up doing the math. And you realize that you don't have a good investment. Even doesn't matter that you don't see it on paper or you don't think about it in your mind. It still turns out to be an investment that leaves a bad taste in your mouth. You know lots of people like this, because most of us are pretty good at math. But you know tons of people who only have feelings about stocks and follow the person and this and that, but they still know when push comes to shove. Like all the kids, all my daughter's friends who opened up Robinhood accounts and thought they were going to be millionaires because they were trading AMC and whatever, which of course I told my kids to stay far away from. GNC, AMD, I don't remember, whatever it is. It was a GameStop, GME. It was GME. It was GameStop, GME. It was AMC Movies, which made no sense at all. You have to have absolutely no knowledge of the business to be playing that thing. Anyway, so they put their money in Robinhood and they all started day trading for like a little while, and the markets were this back here when it was crazy. And it was idiocy, and they all lost their money. But they all realized it. They didn't take them long to realize it wasn't working. This was not a smart thing to do with their money. So they bought Bitcoin. People drive me nuts. But anyhow, the point is, it's apparent, it becomes apparent to almost everybody that they're in a bad investment. And that's the problem. And so for me, it's just math. For me, I look at it on paper, I can say right away, bad investment, doesn't pay. Wow. Only 15 minutes till the Fed. All right, where were we? One of these things, portfolio review. That was what we're talking about. Nope. That's not it. That's it. All right, so super hedges, blah, blah, blah. Okay. All right, then we have our money talk portfolio. I was just on the show 2 weeks ago now. I was on the show, and we talked about it there. And how much? Up $18,000. So we're up $18,000 since then. And well, that's interesting. So yesterday it was 307, and today it is money talk. Ooh, that looks bigger. 314, up 7,000 since yesterday without being touched. That's pretty good. So, these are because they're good stocks, and if they're good stocks and nothing bad happens in the market, they should go up, right? That's the whole point. So they made $7,000 since yesterday. This exact portfolio here, look at that one-day return. That's pretty freaking good. But they were up $18,000 in 2 weeks. Now they're up $25,000 in 2 weeks, because it's still 2 weeks. And that's like 10% of the portfolio, which is great. And you're not always going to have a great 2 weeks, but this was a good 2 weeks. It's just, again, it goes back to, it's all about value. The options part is easy. Sell premium, but not too much. Batman had a thing today, and he was talking about, I forget what stock it was, but he sold way too much premium. He sold too many short calls. He was basically bearish on his position, which didn't make any sense. And also messy. I don't want to point him out, basically, but we were talking about this position, Oh, Avga, Broadcom. So, you know, he's got all this stuff here. He's got 98, 85, 14, 25, 22, 14. Oh, and by the way, these two. And it's like, first of all, I don't do that. I don't do that because I get confused, and I am a freaking genius at this stuff. I can't keep track of all those positions, and I don't remember what the hell the purpose of my trade was. So I will spend money to consolidate my short calls to make sure I only have one or two short call positions. Otherwise, I am like, how am I supposed to look at a whole spreadsheet full of stuff and figure out which things I should adjust when I can't even figure out this one freaking position? What the hell is that? Am I bullish? Am I bearish? What's Broadcom got to be? Do I have a target? What am I trying to accomplish? That's how your positions get out of control. All right, it's like if you ever drove a truck and it's got like 16 gears and a different thing, and it's a, it's like if you don't know how to use it, you're going to crash, right? There's too many freaking things. That's why you have to go to special school to drive trucks. It's not the same. All right, so why be complicated? Okay, if you get into a regular car, it's got a little shift, it's got forward, backward, and stop, and that's it, basically. Forward, backward, stop, hit the gas. That's how fast you're going to go. That's how your portfolio should be, right? You're bullish, you're bearish, you're either bullish, bearish, or neutral. Here's what you're going to do to make each adjustment. If you can't do that in 2 seconds, you have too complicated a position. You gotta avoid this kind of stuff. It's terrible. It's very, very bad for you and very dangerous because God forbid, and again, God forbid the market drops 20% and you have 40 positions that look like this. You have 200 buttons to push while the market is dropping, and you need to know which one you need to push. You can't push the wrong one. Which is the one you should be pulling? Which of these pieces should be added to? Which one should be adjusted? You've got no freaking idea. Took me a half hour just to answer his question. You can't do that in a portfolio. It's too dangerous. So anyway, generally I favor simple positions. Okay, see here's gold. Now, in gold, we sold the short calls. We sold the January 27 short calls. When did we sell them? We sold them in May. Why did I sell them in May? I don't know. Why do you ask me such a complicated question? I have no idea. Let's see if we can figure it out. Gold, gold, gold. So what happened in May? Oh, wow, look at that. Okay, there you go. Well, that explains it. In May, we had topped out at 25. I was still greedy. But then we had this big drop. And I said, well, screw that. And so we sold the short calls. That's what happened. So on May 13th, as we were having that drop, we were still able to get 280 for the short calls. And I said, sure, let's take $7,000 by selling half the short call covers rather than just staring chart. Rather than just watching this keep happening to us. So somewhere around here, before we fell below 20, I said, let's sell these things while some sucker's still willing to pay us money for going past the highs, and it doesn't look very likely we're going to get there again by the end of the year. Well, I was extra right. I would have been better off shorting, frankly, but I was extra right. We kept falling down, whatever, and now we're back here. All right, but so these are going to expire worthless, and we picked up $7,000 to offset the loss in the main. This has been rolled since then, but in July we rolled it. So, but we're offsetting the loss in the short position. Oh, by the way, so we take this $7,000 though, and what do we do with it? In July, when we got down to 14 bucks, not in June, I waited, right? Here's June, we're down here. I waited. In July, we had this extra move down, and I said, you know what? I'll take it. And that's when we did our roll and repositioned ourselves. We took the 7,000 we sold up here, we put it into rolling the position here, and now we've got a position that's profitable. Nicely profitable and very well, very easy to target. Now we only have to get to 20 to make our goal. And believe me, at the time I would have done the math, and we certainly are going to come out ahead on the overall position. You know, again, it's because it's simple. Not too many moving parts, right? We have our long spread, we have the short puts, and for whatever reason, we sold these fairly recently. And that's where we are. Intel, same thing. We sold these short calls, and it was the same thing. This is back in July. Intel was falling. We thought it was a little, you know, look, it starts falling, and I say, oh, is it going to recover? If it's not going to recover, then let's sell to some idiot who thinks it's going to recover. So in July, we can see it here. So in July, on the 14th, oh, good timing. So on July 14th, I decided that Intel was not going to go to 40. That's what I decided. And so, well, okay, let's look back at it. Let's look at a longer term chart. So what had it been doing? Oh, well, to be fair, we only got a bounce back. So we had a bad crash. We bounced back. We came to 40. And I said, we're not going to get back to 40. You know, we had this weak bounce. That's why we always measure. That's why, you know, I drill that into you guys. Is it a good bounce, or is it a weak bounce and a strong bounce? If it's not even, you know, weak bounce is the minimum you expect. Strong bounce is good, but only if you pass it. If you fail the strong bounce, you're probably going to continue going down. Boom, we did. Much more so than one would expect. But the point being that at that time, I said, screw that. We're going to cover 50 out of 75. We're going to do 2/3 cover at 550 on the $40 calls. All I'm saying is I don't think it's going to go past 45.50 by the end of the year. Well, not by the end of the year. It goes all the way to next year. So we sold those for 550. They're now 118. We already made $21,000 on those. Thank God for that, because the rest of the position was terrible. We ended up having to roll it and do stuff, but it helps to collect 27,000 bucks to do that. JP Morgan, another fantastic stock. So there's no problem with those guys. They just go straight up. Logitech's been going straight up. SoFi this is very speculative, but I think they're going to do well. And Yeti is our new trade of the year. And that one's already on a decent track. Where is the portfolio? Well, here they are. And that's the other point. So how much are we going to make? Every position, and this goes back to that Batman thing. Every position, if you can't do this, get out of your position. You did it, your position is bad. What are we betting? What is our goal? Okay, we bet it will be above 100 in 2 years. Simon Properties at 118. I'm betting it doesn't fall to 100 over the next 2 years, and we're going to make 7,000 bucks, right? So it has $7,000 upside potential. That's what that position is there for. What's gold's potential? $34,000. Also, you got to say, is it realistic? So gold is a 10-20 spread. We're at 17, or close to 17. So is 20 realistic? Yeah, it's realistic. 20 is basically the baseline without this stupid downside. And you know, we believe there's still going to be inflation, and gold's going to go up in price and probably get to 2,000. So yeah, this is a great trade. It's going to make 212% in 2 years. Nope, 5 minutes till it filled. Oh, something filled. What filled? That was me getting out of my oil. There we go. So see, now we're well, it's weird. P&L from the open. I don't know. Anyway, so now we're up on oil. So remember, I put that trigger down there. So now we're back to 3. I only really wanted 2, but I think, I don't want to be too greedy. So we're at 77.50 now. Well, these guys are not weak. He's weak. Oh, I guess I can sell that other S&P. Do I want to do that? Do I want to risk that? I do, because I did the math. I got to have faith in math. So let's sell one more of those. That filled immediately. That always makes me nervous. And I guess we'll go back to the, since I'm now too short there, let's just be too short here. So now we're good. So now that's our spot. 77.50 is where I want it to be. So I got too short on the S&P and too short on oil, and that's based on my theory that the Fed can't possibly not be going past what people think they're going to be hitting on rates. That's what I believe is going to happen. All right, so anyway, so we do the math on every single position, how much we have to gain. Now notice on SoFi, it's a little too speculative, so I'm not going to call that anything. I'm not going to count on it, is what I said here. So I'm not going to say how much I have left to gain on it, because this may end up being a write-off position. We don't know. I do believe in it, but it certainly doesn't believe in me, and we'll see what happens. Yeti, and then blah, blah, blah. So this portfolio, which only has, this is cash, not margin, only has $43,000 at play. Those positions at net $43,000 have the potential to make $150,000 between now and 2025, over the next 2 years. To make 150, not to be 150, to make 150 off of 40. So that's basically 400% upside potential on the positions that we have now. We also have a ton of cash on the sideline that will eventually put to work also. But the point is, so how are we playing this? So we have tremendous upside potential. We've got plenty of cash in case things go lower. Every single position in the portfolio is one I don't mind adding to if the stocks get cheaper. And that's how we're going to get through the next quarter. Then we'll see what the reality is. We'll see what the earnings are, and then we're going to reevaluate every single one of these companies and say, well, based on this earnings report, I'm willing to do this, and I'm willing to do that. That's what we just did. And based on those earnings reports, we cut half the positions in our portfolios because they weren't strong enough that I'm willing to sit through a 20% drop in the market that's very possible in the recession. I gotta really, really love something to want to hold it up for 20%, like like a car. Okay, let's say you invest in your car $50,000. You got 100. Let's say you buy a $100,000 car. Okay, so you buy like a nice Porsche or whatever like that, and it gets damaged. All right, do you love it enough to fix it? That's the question. If you don't love it enough to fix it, if the insurance company doesn't love it enough to fix it, it gets totaled, right? They call it totaled and they give you the money and you're done. And you go get yourself another car. If it's my wife's Mustang, she's going to fix it because it's a 68 and it's in mint condition. Now, again, it depends how bad. I'm going to sit there and say, it's just a freaking car, get another one. You know, she's going to fix it. I can tell you right now where that's going to go. You can't be in love with your stocks, so, and you can't be in love with your cars either, for that matter. But that's another point. But you can't be in love with your stocks, and you shouldn't put too much money into them. They've got to be able to do the work for you. You have to say, if I do this, then what's my position going to be? And then is it worth it? Is it worth the money I'm investing now? Because you're not obligated to save this position. We went through the long-term portfolio. There was a couple of them that I was like, holy shit. I mean, these are freaking amazing positions. What was it? I forget. You know, CIN is always good for a new trade. coin. I'm trying to remember it. Gold, Google. Oh, Google. No wonder this is a trade of the year finally. It should be in everyone's portfolio. Oh, and that's one I considered messy. Let's see what I can. Here's what I consider messy as a position. Yeah, because we got 5 legs, so I consider this messy. And why do we have 5 legs? Because we have 2 different puts. We have the 2024 puts and we have the 90 puts. Because we sold them at 2 different times. We originally sold these. Google went lower, and I said, "Well, that's so low. I can't. I don't want to buy these back because I still think they're going to go over 100, and I want to sell more." But the 90s were more attractive to sell than selling more of these 100s, so that's what we did. Then we've got, well, obviously we sold the 90s for the same amount of money we sold the 100s for more money, for 12, 15 instead of the 100s for 10. So, and as you can see now, they're about the same price. So if I could sell the 90s, which are lower in strike, for the same money I could sell the 100s for, why would I sell the 100s? Otherwise, though, it's a perfectly normal 100, 120 spread. Wait, what? Oh, I see. Oh, that's also why it's messy. Look how weird that is. So we had some $90 calls and we had some $100 calls. So we bought it 2 different times and we sold the 120 calls both times. So that's why this is kind of a weird position. And that's going to annoy me, and I'll probably eventually consolidate it. I mean, I'll probably pay to roll the 100s down the 90s because the difference is only $5 to roll it down 10. So if it ever gets to like $3 or $3.50 to roll it down $10, of course I'm going to do that, right? Because I believe in the strikes. So anyway, so that's great for a new trade. It's 100. Oh, look at it. That's why it's $100,000 spread, and it's currently net $5,000. So it's going to make 20 times basically. It's going to return 20 times your investment if Google is at 120. So here's Google, and here's our target for 2 years from now. So if we can get back to there, you're going to turn 5,250 into $100,000. And I even wrote a little thing here. I said, you know, I'm like, well, you know, obviously if you see that, oh, freaking Fed, oh, market's falling, haha. FOMC vote was unanimous to what? Oh, 0.5 point. It's a 0.5 point hike. Look at that, 0.5 point hike, and the market doesn't like it. Unbelievable. Unbelievable. The meeting. It is unbelievable. La da 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 da. Oh, projections. I love projections. I'm excited. All right. Fed median. Oh, that's ugly. Median forecast for the GDP growth is 0.5%. Ay, ay, ay. So they know they've completely fucked over the GDP and they're still tightening by 0.5%. Fed, I'm reading off the TV. Fed says job gains are robust, unemployment has remained low. Oh, I hate the TV is so slow. Seriously, do people really take this long to read something? The Fed will continue to reduce Treasury and holdings as planned. They're still reducing their mortgage-backed securities and treasuries. I said this today, right? They have to keep doing that. All right, median forecast shows rates at 5.1% in 2023 and 4.1% in 2024. So they have not really adjusted their dot plot up. That's interesting because we're now at 5%. No, we're not at 5%. We're at 4.75. Inflation, here's the thing, they're in fantasy land. Inflation next year, they think is going to be 3.1%. They predict 3.1% inflation next year, and we're at 6% now. It's going to just magically drop and drop and drop for them. I don't find that realistic. They will continue to reduce Treasury more. Okay, but now we're rolling. All right, let's read the notes. See if anybody's got any questions. Look at that. Holy shit. Not getting much on the oil, but look at that S&P with two lousy things. Wow. Wow. All right, very nice. See? See, and why is that? Because all I did is logically go through the data. 60 seconds. Okay, 14, we just ignored it. Fed day was November 2nd. Okay, so I said, okay, what do I do in the morning? Okay, what happened last Fed day? Last Fed day, we went from 3,900 to 3,700. That's 200 freaking points on a 0.75% hike, which was expected. All right. So last Fed day was November 2nd. The market was looking for a 0.5 hike. We got 0.75. Okay, 0.75 is more than this. Oh, that's right. Because before the Fed, they had talked about it being 0.05, and it was bullshit. So we got 0.75. And don't forget, Powell's still coming on. That's when things really fall apart. Notice that the Fed last time, it went up after the Fed. Look at that, 2 o'clock, up, and then over, and then Powell started talking, and that was doom. So we've still got some fun ahead of us, guys. All right. So I said that's down to 200 points on ES in the session, which is more than a fake rose yesterday before selling back off. Now 4,050 pre-market. 3,900 is where we got to in anticipation of the Fed slowing to a 5% in the last meeting and 0.5% or less at this meeting, and that is 1% total. So in other words, the thinking last time was that the Fed was going to hike 0.5% then and 0.5% now. That caused us to go to 3,900. They did in fact hike 0.75 last meeting. So if they hike 0.25 now, you're back at the same 3,900. There was no way they weren't going to hike 0.25. That was a definite. So I said, well, based on that, there's no possible way. And I said, so using math, not TA, it's math. And that's why, by the way, when people say this is what happened last time, therefore this will happen, that's not what I'm doing. I'm saying these are the conditions that led to what happened last time, and how similar are the conditions now, and what's the thinking now compared to what the thinking was last time. You got to take all that into account. You can't just say because last time this is what's going to happen, although it turns out to be almost the same thing anyway. So where are we? So, okay. So using math, I'd say anything more than 0.25 hike, which is not going to happen, will not support 4,000 this afternoon, which makes shorting the S&P 500, shorting SPY at 401 or ES at 45, 4050 this morning is practically a sure thing. Now we did go higher, right? We went higher. Oh, look at this. All right. So we went higher for a while, but it's still ultimately, once the Fed actually makes their announcement and it's over 0.25, all this exuberance goes out the window. You're just predicting the behavior based on the conditions, and you're predicting the conditions based on your observation of what's realistic. All right. In other words, iguanas in Florida fall out of trees. If the temperature goes below like below 40 degrees, the iguanas get frozen and they fall out of the trees. They can't hold on to the trees anymore and they fall out. So if there's a sudden overnight chill, that's when it happens. They're not stupid. They don't climb the tree half frozen and try to get up there. They're up there in the sun on a 60, 70 degree day, trying to 60 degree day, let's say, and they're trying to catch some sun because that's chilly for them. And they fall asleep, and then it gets dark, and for whatever reason, temperature goes below 40. That effectively puts them into hibernation mode, and anything that rocks the tree, they fall right out, and they bam on the ground. They're generally fine, but it's like really funny. You see these like dead-looking iguanas sitting around. Anyway, so cause and effect, though, right? If I see an iguana in a tree in the summer, it's not going to fall out of the tree. If I see an iguana in the tree in the winter and it's cold, I mean right now it's 80 degrees out. But if I see an iguana in the winter and it's a cold front coming in, and I look at the temperature, it's going to be cold at night, I can predict an iguana is going to fall out of the tree. It's the same iguana in the same tree, in the same position, but it depends on other factors whether or not he's going to fall out of the tree. That's what this is, falling out of the tree. Okay, it's not going to happen every time. It's going to happen every time that the other conditions are similar as well. And I said 4.57 was the upper limit of the Fed's dot plot next month. Nobody was predicting in 2022, well, one guy, but nobody was generally predicting in 2022 that we'd end up above 4.5%. Next year, they said maybe we'd be up about 5%, okay? Now we're at 5%. So, well, not yet. No, I'm sorry, not yet, but anyway, so we've blown past these numbers and nobody was expecting it basically, okay? We're past the high for the year. Everybody's upset. Of course they're upset. What happens then? Everything goes down. This is what happens. Whoop, look at that. And take that off the table. It's a good day's work. Oh, definitely taking you off the table. All right. And we're done. All right, so we got the reaction we wanted. We're not greedy. Made $4,500 there and made $590 there. By the way, made it right now because when you guys came in, we were losing, right? So we made all this money just while we were talking. And that's all you got to do. Just pay attention. Pay attention because nobody else does. Because these people on TV give you the worst superficial bullshit analysis possible. They just tell you what you want to hear. They tell the masses what the masses want to hear. No, believe me, I'm on the TV. I know what happens. I've got a whole big giant point I want to make. I take, I mean, frankly, one of the reasons people think I do good on TV is because when the people ask me interview questions and I give them an answer in pre-interview, they always pre-interview you. When they pre-interview you and I give an answer and say, well, you're gonna have to cut that short. I'm like, you know what? Why don't we do another topic? I'm not going to sit there and talk about a really complex topic and tell you in 2 sentences what it is. Phil, it's like, Phil, explain the Russian free trade agreement. Go. It's like, 10 seconds. That's the state of financial journalism, though. It's ridiculous. And that goes for this whole, even now it's like it's so hard to get people to read. The Wall Street Journal now tells you how long it's going to take you to read the article, and the Times is doing it too. Where's the Times? They started doing it too because they got to compete with the Wall Street Journal. Oh, they're not doing it now. Interesting. They were doing it for a while. I was getting really pissed at them because nope, there it is. Look, 5-minute read, bastards. 4-minute read. What is this? I need to know how long it's going to. I'm not going to click on an article because it's going to take me too long to read it. I guess that's what happens. But what does that mean? You're now encouraging brevity? Even in the frickin' print industry, we're telling people to cut down on the explanations. Don't go so in depth with your coverage. Where is in-depth coverage going to be? Who will provide in-depth coverage if not the frickin' newspaper? It's insane. I guess Twitter will because they're going to 4,000 characters. So if you want your in-depth coverage, maybe Elon Musk is right. Let's go to Twitter. Because 4,000 characters in the newspaper, you're going to get fired. Oh, I'm telling you, it's insane. Everything's crazy. All right, let's take a look. Recent indicators point to modest growth in spending and production. Job gains have been robust in recent months, and unemployment rate has remained low. Inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher food and energy prices, and broader price pressures. Russia's war in the Ukraine is causing tremendous human and economic hardship. The war-related events are contributing to upward pressure on inflation and weighing on the global economic activity. The committee is highly attentive to inflation risks. The committee seeks to achieve maximum employment and what is the meaning of this? What is the meaning of maximum employment when they are actively trying to knock down jobs? That's a joke. Inflation rate at 2%. Yet they say next year we'll have 3.5% inflation and they're going to pause. That makes no sense. In support of these goals, they're raising the rate to 4.5%. Okay, the committee anticipates an ongoing increase in the target will be appropriate to attain the stance of monetary policy sufficiently restricted to return inflation at 2% over time. That's a long time. Not even in 2024 will they see 2%. In determining the future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects, that's important, the lags with which monetary policy affects economic activity. That's an important concept because it means that they understand that the rate raising they've already done will have longer term effects that will kick back later. So in other words, they could easily over tighten because you won't know you've over tightened until the economy is collapsing from too high rates and we're not functioning anymore. And then they've got to go back and do it the other way. So they're going to pay some attention to that. That's nice. I'm glad they're doing that. Economic and financial developments. In addition, the committee will continue reducing its holding of Treasury securities and agency debt. This is bad. This means the committee, they will be spending less money bidding on bonds. That's why we're having these terrible bond auctions. The Fed has been the primary purchaser of U.S. bonds for a decade. They've been the #1 purchaser of U.S. bonds. Now they're going to stop? That's not good. As described in plans, blah, 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 Fed's balance sheet, they issued in May. So in May, they had a plan to do it. They're going to keep going on that pace. That was a scary pace, and it's going to become a big problem. The committee is strongly committed to returning inflation to its 2% objective. Boy, they keep saying that, don't they? Isn't that weird in such a small statement that they keep saying the same thing? In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information, economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if the risks emerge that could impede the attainment of the committee's goals. The committee's assessments will take into account a wide range of information. This is such nonsense, blah, 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 blah. Everybody said this was good. They all voted for the same thing and end scene. Okay, so that's where we are. How's my market doing? Well, yeah, good. Glad I took the money. So, look, a half a point is better than 7.5 points. So we're, it's an okay thing, but it's still, like I said, not supportive of really being over 4,000. Speaking of, here's the Fed statement. For some reason, I have it twice. There's the thing. Now we can look at the data. I love data. I love data. You have to stop me from over analyzing my data, because I could do this for hours. All right. So, ooh, it's not good. All right. So GDP, half a point. Really? Half a point? Half a point? Okay. The problem with this is the debt is still growing and the GDP isn't. So if your debt is what the frick is our debt? 30, it's 30 trillion, right? Yeah. 32 trillion. So debt's $32 trillion. And our GDP is 25 trillion supposedly, or something like that. So that's okay. But the GDP is not growing. 0.5% is, 1% would be 250 billion. So it takes 4 years of 0.5% growth to go from 25 trillion to 26 trillion. So we're not talking about any serious kind of growth here. But debt is growing at 1 trillion, 1.5 trillion, which is 5%, let's say. So that means in 4 years, we'll have 20% more debt. So it's 32 plus 6 is $38 trillion. We'll be close to $40 trillion in debt. And our GDP will be effectively the same. So our debt to GDP will become significantly worse in the next few years. That's not good. How is that going to be positive economically? So that's problem number one. Change in real GDP, unemployment rate. Unemployment rate, they expect to be higher. This is how the Fed says they maintain maximum employment, by raising the unemployment rate. It's gone higher than the September projection in outgoing years. Inflation. Oh, I see. So September. So now they're admitting that inflation is going to stay higher than they thought. Blah blah blah. So it's 5.6 this year. Where the frick did they get this number, right? Because that's bullshit. 5.6 next year, 3.1. Well, if they're going to call this 5.6, then maybe next year could be 3.1. But it's already up 10% from where they thought it was in September. So they don't know what they're doing. It's going to stay at 2.5, 2.1. That's fine though. That kind of inflation. The Fed funds rate 4.4, 5.1. I don't believe this. See, here's the thing. I don't believe this, and therefore I don't believe that. I think they're going to get to 6% next year. So, you know, we're at, oh, those are the minutes from the last meeting, I see. All right, so we're at 4.5 now. I mean, I don't know what they're even saying. They're saying they're going to have very, very small raises next year. We'll see what happens, I guess. But I think inflation is going to be coming back, and they're not going to be able to do this, especially people getting year-end bonuses and or raises into next year. I think that's going to make a big push of corporate expenses going forward. Not only that, though, but companies have to raise prices. There's a lot of companies right now are wrestling with the whole concept of raising prices. They can't afford to not, otherwise their earnings are going to suffer. Wow, the bonds popped. Let's see what that looks like. Yep. So when these go lower, it means the rates went higher. What else we got? Economic projections, change in real GDP. I don't know what this is. Now, actuality. Okay, so last year's 5.7. So last year's 5.7. Now we're at 0.5 from 5.7 last year. We had a minus 1.5. That was bad. So if you average these out, that's like 3, basically 3 going in these last 2 years. Now we're at 0.5. So what's really significant here is, okay, we went down, then we went back up, right? Although we went $10 trillion into debt to get back to here. We went down, we went back up, and now we're flat. That's just really not good economically. The unemployment rate, 5.3, 4.8, doesn't matter. PCE inflation, upper end of range. I can't believe that nobody thinks it's going to be higher than 4% next year. I find that amazing. I really do. I don't know where they're getting these numbers. And how can the core PCE be higher than the PCE? It doesn't even make sense. This makes no sense. I don't know. I guess they figure oil is going to collapse because this is X food and energy. I don't know what they think. And meanwhile, X food is so insane, right? Because think about your grocery bill and all the money things cost. I was pretty shocked. I went to Whole Foods. When I go last weekend. Was it last week? What day is today? Tuesday? No, it must have been during the week. Anyway, I went to Whole Foods, and I don't know what most things cost. I don't look. Which is good in Whole Foods because they don't have prices on half their stuff. That's a funny thing, by the way. I did know that, but I kind of don't think about it. But then, I was curious last week what things were costing, and I was just sort of like, you can't find out. It's not written on the stuff. It's not written on the item. It's not written on the shelf. Not most. I don't know if most things I buy. I don't know. But whatever, but they're just not marked with prices. You're just surprised when you get to the register what things cost. Anyway, so and oh my God, so many people now. Aldi, there's a thing called Aldi. It's like a German supermarket thing. Everybody goes, go to Aldi, go to Aldi. It's so much cheaper. I'm like, I don't know. I like that I know where the stuff is at Whole Foods. But anyway, so Fed market assessment of appropriate monetary policy, blah, 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 blah. So most people say 5.125%. Here's a couple of people who agree with me. 2 people agree with me. Look at that, 5.6. Getting there. You're getting there, kids. So 4.3, we've blown past this. Distribution and projections for changing GDP. Wow, okay, so you can see people all over the place with numbers. So that's what this is what the dot plot effectively is. There'd be 1 dot here, 2 dots here. That's what all this is. It tells you like how many people believe that. And these are the Fed members. So this is what they believe. And it's kind of important to know what they believe, because when they're wrong, you have to start saying, well, they're going to have to change their mind on policy. They thought this was going to happen. This is not happening. So we shall see. It's going to be interesting. Oh, Bruce says there's an expression out, TLDR, too long didn't read. Oh, that's horrible. Look what we've done. Look what we've done to our children, right? Isn't that awful? Do you still think the S&P will continue down from here below 4,000? That's a good question. Robin asked a very good question. Well, Robin. All right. We're kind of done. Well, we got the non-farm payrolls, right, on Friday. Oh no, what am I talking about? That already happened. Wow, I'm like 2 weeks behind. What the hell? No, this year's over. All right, so there's no more catalysts. That's the key. There's no more catalysts. This was the bad news. What else is going to be bad news? So I think we're going to finish the year exactly where we're supposed to finish the year, which is basically at S&P 4,000. I mean, maybe up and down 100 points, 200 points, but 4,000 was my target for the year. It's exactly what we expected to happen. And that was based, and I wish I remember where I put that article, because it's like I didn't make a big deal of it when I did it, but I should have, because just for the fact of being able to reference it back. But I had gone through all the S&P stocks, not all of them, the top 20, which are basically a third of the S&P in evaluation. So I went through the top 20 S&P stocks and the top 20 NASDAQ stocks. And for each and every one of those stocks, I did evaluation and said, this one should be here, this one should be here, this one should be here. Based on that, that's how you come up with a valuation for the index. It's not hard. And so that's where those lines on the chart, that's where those support lines on the chart came up from. And that's where we are. We're exactly where we thought we'd be given these situations. We knew about the war. When I recalculated, we knew about the war, but this was actually before we knew about the war when it started. But the war didn't change it enough that we should recalculate. That was the only major change since we started doing this, was the war. How bad is Coca-Cola affected by Putin and so on and so forth? Some companies, yes, especially supply chain shit and energy shit, but generally, it doesn't really kill US companies. So I think we're going to shuffle around 4,000. I don't think that's going to change. And I don't see, if I can find briefing.com. Where is that? Okay, let's try this. BRIEF, briefing.com, economic calendars. Yes, okay. So what's going on? We've got retail sales could affect us negatively. It's hard to say. It was 1.3, they're surprising up. Now they think it's going to be down. You guys, I'm pissed off, by the way, because not very few people actually filled out our winter shopping survey, and I'm sorry, but I like to know these things. December review, Thursday bounce. I guess maybe I should be reminding people more often. Trade of the year. When did we do that? That long ago? I tell you, time just flies. There you go, holiday shopping survey. So I really would appreciate if people did fill this out more. Only 4 comments. You know, the article is not important. What's important is this. So look, 26th, 28th, December 1st, December 3rd. I bought everything online as usual. We're in Bangkok for a month. Shopping malls not busy. Luxury item stores with barely anyone in. This is important information, right? If we all contribute, this becomes really valuable stuff. We used to do this. We had 100 comments. I don't know what's going on these days. I was at Walmart in Ontario. It was slow and quiet. Large segment of shoppers taking advantage of self-checkouts. Blah, blah, blah. I think it's funny the retailers finding suffering from insufficient staff. Shoppers are suffering. Shopping at Lino Lakes, Minnesota, Target, I guess. This was not too busy. Walk right through the checkout. Traffic looked like a normal Saturday. This is what we want to know, right? I mean, please, if you have a chance, it's the holiday shopping survey on the 26th. It's really great to get feedback on what people are actually seeing when they're out there. We are much more observant than most people. We are in tune to the economic factors. All we need to do, and it's all we need, is a simple comment. What do you see? Is it busy? Does it look like Christmas? It never looks like Christmas in Florida. That's a weird thing about Florida. It just does not feel like Christmas at all. Oh, but his pal talking. Oh my God, this is a danger zone, actually. Sorry. Hang on a second. Let's listen to this.
50-year low. Job vacancies still very high and wage growth elevated. Job gains have been robust, with employment rising by an average of 272,000 jobs per month over the last 3 months.
The economy has slowed significantly from last year.
And the pace of job gains has slowed.
Yeah, that's because you raised rates, you idiot.
The labor market continues to be out of balance, with demand substantially exceeding the supply of available workers.
Labor is way out of balance.
FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median projection in the S&P for the unemployment rate rises to 4.6% at the end of next year.
I don't see how they're going to get to 4.6 unemployment rate when there's 10 million open jobs. I'm not sure what his plan is.
Total PCE prices rose 6%, excluding the volatile food and energy categories. Core PCE prices rose 5%. In November, the 12-month change in the CPI.
Wow, they're assuming that yesterday's drop in prices is going to be the norm. Like they're totally discounting that it could be a one-time drop. And we know it was because oil dropped off so much.
It will take substantially more evidence to give confidence that inflation
It'll take substantially more evidence to get confidence that inflation is on a sustained lower path. Restrictive policy necessary for some time. Boy, we can watch the market while he's saying this, I bet. They're not good things. Ooh, that looks way ugly in the other chart. See how everybody is at the same line? This is what you get when you have a technical sell-off, right? This is what happens when the computers start trading off. They go exactly to their lines. Now, the dollar is not really coming up that significantly from basically half a point on the dollar. And we're getting to see it 2 times. We're getting 1 point drop, but that's a big 1.6 drop on the NASDAQ. But notice how they all hit the same green line on the button. Here's oil still trying to be up, which is crazy, I think. Gasoline much higher than I thought it would be. Natural gas back coming down again. We might get another chance to go long. Isn't that funny? Good old Simon property. Gold coming down a little bit as the dollar's coming up. Silver coming down a little bit. And the VIX is coming back up, but not severe. How? We need sustainably more evidence for lower inflation.
And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.25 percentage points this year.
The real danger is in the Q&A. You know, he's careful in the speech, but when they ask him a question, he tends to like just go off the cuff and give answers that people get really worried about.
Over the course of the year, financial conditions have tightened significantly in response to our policy actions. Financial conditions fluctuate in the short term in response to but it is important that over time they reflect the policy restraint that we're putting in place to return inflation to 2%. We are seeing the effects on demand in the most interest-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized.
And it'll take time for the full effect of monetary restraint to be felt by the housing market.
The committee decided to raise interest rates by 50 basis points today, a step down from a 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go.
50 points is a historically large increase, and we still have some ways to go.
5.1% at the end of next year, a half percentage point higher than projected in September. The median projection is 4.1% at the end of 2024 and 3.1% at the end.
So he's repeating that the median Fed funds rate next year should be 5.1%.
Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be.
But nobody knows with any certainty. That's just their plan.
The totality of incoming data and their implications for the outlook for economic activity and inflation. And we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is...
See, this bothers me. We're taking forceful steps to moderate demand so it comes into line with supply. Why don't you take forceful steps to increase supply? Wouldn't that make everybody happier? So the 2-year is 4.29, the 10-year is 3.5, and the 30-year is 3.5 too. We will stay the course until the job is done. You know, a lot of people were thinking they were going to reverse at some point. They are not reversing.
Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. And we look forward to your questions.
Now it's Q&A time. Okay. So prepare for doom. He just reminds me so much in South Park, where the Fed is a bunch of guys in robes and they cut the head off a chicken, and wherever the head, and there's a board, and where the chicken lands and bleeds, that's how they determine their policy. Like they have different policy statements on the floor, and after they cut the head off the chicken, wherever it falls down and dies, that's their policy. I mean, this is really nuts. They always let the CNBC guy go first. That's always weird. I think there's certainly more qualified people to ask him questions. Anywho, so that's where we are. We will see what happens. Everything seems hunky-dory at the moment, though. We seem to be holding the lines. But again, that's as we should. And now we'll see if it could turn on any question that people take the wrong way. But if all goes well, we should chug along here, which is basically where we've been for the last month. Oh, I'm sorry. We were looking at what could go wrong, right? That was important. Okay, so retail sales, possible problem. This is not a big deal. This doesn't change that much week to week. Philly Fed's been a disaster. Empire State has not been any better. But the Philly Fed has been, oh my, look at these numbers. minus 19, minus 15 expected for this week. That's big. Industrial production also has been a problem. Cap utilization is pretty low. 80% is a little bit too low for cap utilization. The PMI, again, we're going to get more data. Look how that's been not good, right? Below trends. Then we go next week. Housing starts, nope, that's not going to be good. That's not going to be good. Existing home sales, not going to be good. Mortgage applications, not going to be good. EIA, who knows? GDP, not going to be good. The Fed just lowered their forecast on GDP. Claims, nothing. Durable goods. Well, how is it going to be good? If GDP is down, it's very unlikely that durable goods are going to be good. I'm sorry. Boeing just got massive orders, though. I'm not sure. See, that's interesting because durable orders. Keep in mind durable orders. Boeing just got a massive order. That might actually take the entire durable goods sector up. United ordered 100 planes, and you see all the work I got to do when I'm like just trying to find what it ends up being like one line in the Morning Post. I'm like, durable goods should be this or that. I have to go all this research. So Boeing, no, not just Boeing, Boeing United. There are 100 787s, and oh, those are big too. Those are the good ones. Got to cost a lot of money. How much you pay for one of those? Got to be over $100,000, right? See if anyone's paying attention. Oh well, now we got to go this way. So, how much is a 787? 200 million. Okay, yeah, that's about right. All right, so 200 million bucks. Where do they get this euros? That is not the conversion for euros. Wow, they're insane. You see what's funny about this? Because it's like, if you don't know that the conversion's wrong, like if you don't know what a euro conversion is, how can you possibly read these things and know what's happening? It's so stupid. Anyway, okay, so Boeing 77, so 200 million bucks. So it's 100, so it's basically, it's 20 billion, right? 100 times 200 is 20 billion, right? Okay. So $20 billion. Boop, back to you. This is what I do. Like when I'm working on these articles, this is what I have to do just to figure out one little thing. So durable goods, $200 billion. Then I have to go and look at the total amount of durable goods to really make it a proper statement. I then have to figure out what impact percent does that have on durable goods. But I will tell you that it is extremely likely we will have a positive durable goods number, not X transportation, but the durable goods number, because it includes the aircraft, should be up. but that depends on the cutoff because this happened just like 2 days ago, and this depends on what date it's for. Like it says for November. So that happened in December. So it's not included yet. So we'll have to wait till January to get the good durable goods report, and by then we will have forgotten it even happened. Nope, Pal's not helping with the Q&A. Personal income. See, this is what they're concerned about. See, they can't afford this. They can't afford 7% a month, 8% gains in personal income. They don't want to see that. But if the income isn't there, look at the spending falling apart. They need higher income. I mean, they're just doing, their policy is wrong. The way they're running this policy is incorrect. Then we've got PCE prices, personal spending, PCE core, new home sales, another disaster. Consumer sentiment has been a nonstop disaster. And then the year's over. There's not even real data. Consumer confidence, home prices not good, retail inventory is not too important. Pending home sales also not good. Continuing claims is back there. Natural gas, Chicago PMI on December 30th. What a weird day to have it. And there you go. We're done. So I don't see anything particularly. It's going to take us way above 4,000 until the end of the year, but I don't see anything that's particularly going to knock us down either. So here we are. We're at the spot we're supposed to be at. We're at 39.85 at this exact moment, and the Nasdaq's at 11.7. I mean, everything is right where it should have been if everybody had not said anything the other day. That's where things are, for better or worse. Tom said he's still short oil. No, I took it. It was quick money. It was. I mean, you know what? It's if I have any doubt whatsoever, if I've got a well, this was only up $600, but I mean, it was like it was getting iffy. It wasn't falling, and then here it wasn't falling much more. It was sick. We were up 6,000 at one point. It was dropped to 45. So take it off the table. Why mess around? All right, so we cashed it out. When it got down around here, we cashed it out because I didn't want to deal with it. Also, I wanted to pay attention to you guys and not sit there and worry about what this thing's doing for the next 20 minutes. But anyway, so look, on the whole, it's an improvement over the last time he spoke. Right? Because like I said, in this morning's post, I talked about what happened last time. Last time he spoke, we lost 200 points on the S&P. Here's his Q&A. Keep in mind, he read his statement, right? Then the Q&A. That's what killed us. So what's the time now? 2:49. It's only 2:49. He's talking. He's going to keep talking. And then the market's going to go, oh. But I don't know that, look, 0.5% is the first time they backed off in a very long time, been like 4 consecutive meetings of 0.75. So for them to go to 0.5 is saying we recognize that we may be getting towards the end. Now you can debate whether the next meeting is going to be 0.5 or 0.25 and the one after that is 0.5 or 0.25. Probably though, most people are going to say at worst 0.5 at the next meeting, and after that I really don't see how they can do another 0.5. And their dot plot is now saying they're not going to go past that at the next meeting. So they're saying 5.1. I was saying 6. I expected it to be, this is fine. I don't mind the 0.5 now, but I expect at least 2 more 0.5s. I expect another point from where we are now. We're at 5. So I was expecting 2 more hikes after this. They're saying no. So we shall see. Okay, so they're basically saying if you infer from their dot plot that says 5.1% is the top of the range for next year, and this Fed hike, what are we officially at? I always get confused because of the stupid ranges. Ay, ay, ay. Nope, don't want that one. Okay, so they've raised the rate to, it is now, I'm sorry, it's now 4.5%. So this is only 4.5%. So to get to 5, it would be an 0.5 next meeting, and we're at 5, and maybe an 0.25 after that, but then they're done. So basically what he's just said, or what the Fed has just basically said, and so far he's not contradicting it, is we're done raising rates for now. We think this is enough. We think that, but that's based on the fact that they think inflation is going to keep coming down significantly without them doing any more work. They think that the 10 million open jobs are going to fill without any actual people immigrating into the country, without anybody getting off the couch and joining the labor force. And I talked about that last time we had the Fed thing, which I have links to from today's article. But last time I went into details about what I consider the biggest problem that we're not addressing is women in the workforce. I think you've got 20 million women who are raising children, who are not in the workforce, who are perfectly well educated, perfectly capable people who could fill all 10 million jobs if you only provide a realistic daycare system in this country to let these women go back to work. So rather than raising rates and torturing people and making people homeless and knocking people out of houses and causing seniors to eat cat food, rather than doing that, how about you instead invest in daycare programs around the country that allow women to drop their kids off and go to their jobs? That would be great for the economy. First of all, you've got daycare jobs, you're building daycare centers, you're building daycare jobs, so on and so forth. There's money flowing in the economy. The women are able to go out and work and be productive and increase their household income, which will increase spending, which will increase the GDP. Very, very simple to fix. Do that instead of torturing everybody with higher rates. So it is all going to be very dependent on the incoming data that we get over the next few weeks, what they're going to do, but they don't do it until February. The next Fed meeting, go back one more, the 2023s, where is that? 2023 is at the end of January. So it's going to be all the way to, it's another, more than a month, 6 weeks from now, basically, is the next meeting. So the data for the next 6 weeks is what matters. And we just looked at the data for the next 2 weeks, and we shall see. But it's more a matter of what the data in January says and whether or not this this drop in CPI looks like a one-time thing or not. If CPI goes back up in the next, if CPI goes back up in the next 4 weeks and is higher than it is now, that it was at yesterday's print, then everything he's saying is out the window and the market's going to crash. So we got, again, it's rough waters. That's why we got a lot of hedges. That's why we got a lot of cash. It's like, I don't mind putting more money into the stocks that we have now. If you want to give me more Google and you want to drop Google at 80, I'm happy to buy more. Okay. I said Intel. Here's Intel, a trade that's just throwing money at you. And I said 15, even at 30, blah, blah, blah. 17.5 on an $80,000 spread for Intel. I'll be very happy to buy more of that if I have to. You want to force me to do things like this, I will. Lockheed Martin's our stock of the century, and that's, well, I don't think it's 17,000 anymore. Anyway, so that's really good. MDT, Medtronic, fantastic company. Love them for that price. Meta, Facebook. I really believe they're beaten down enough, and this is a $22,850 on a $200,000 spread. That is the other one I was thinking of. It's like, why would you not take this? But this is the same crap we did in 2009, right? How on earth can you not want to do this? It doesn't make any sense. It's like, this will make 10 times if it works out. 10 times. It'll turn $22,000 into $200,000 in 2 years. And all you got to do is say, okay, Mark Zuckerberg is building a metaverse. He believes in it so much he changed the name of his company. He's all in on this thing, but it's still freaking Facebook. He can afford to be all in on it because he's got infinite amounts of money being generated by this company that nobody seems to want. And the premise for it being down here is that Mark Zuckerberg is such a psychopath that even if this thing keeps losing money, he'll keep spending money and your returns are going to vanish. But why didn't we say that about Jeff Bezos when he was doing the same thing with Amazon? He spent every penny they made and billions of dollars of the investors' money. And he said, I'm going to deliver stuff the same day you order it. Which, by the way, lasted for like about a week, right? And then it's gone. Now it's completely out the window. Because it's not realistic. He actually got to the point where he could do it, but as soon as he started doing it, because I was getting shit the same day. We were ordering things and getting them the same day, and I was like, what on earth is this stupid thing? I don't need like batteries. I can order batteries, and all of a sudden batteries would be in my mailbox. And I'm like, what on earth is going on here? It's like, how does that even make sense to do? They don't even ask you if you really need them. They should have said, for the sake of the environment, do you actually need these things in 4 hours? Is that important? You'd be like, no, they're batteries. I need some. I saw I only had 10 left. So within a couple of weeks, I might need some more. Anyway, so it's the same thing. So in other words, so to me, it's the same thing. Zuckerberg's not irrational. He's not going to blow up his company chasing this metaverse thing. And God forbid he's right, he's going to be a trillionaire. He's going to own the metaverse, whatever that is. And well, we kind of know what that is. It's where you put on goggles and you're in a virtual world. And that virtual world will be valuable. In fact, it'll be the next internet. That's what he firmly believes. He's building the future of the internet. And you know what? Do you remember when they built the internet? Do you remember when you had AOL? Squawky little boxes and things like that would make all these noises and took forever to connect, and you'd wait for the next screen, 30 seconds for the next screen, 30 seconds for the next screen. It was nothing. It was like Stone Age compared to where we are now, and that was only 20 years ago. So yeah, right now you've got to wear a big clunky goggle to play in the metaverse, but do you think that's going to last? You think in 20 years they're not going to have something that's basically glasses that'll give you the same experience? Or maybe a room that has screens all on the walls and stuff like that, like what they call a holodeck on Star Trek, like a room that's all screened up and maybe projects other better images or 3D things and stuff like that. And you'll be able to, so in other words, if you want to go to a mall, you walk into your little holo room, and everything that you would do in a mall is right there, including talking to clerks and things like that. You just walk into a room in your house that has projectors and stuff, and you are walking through the mall, and you go to the store, and you look at everything, and you try it, and you test it, and you can put it on, and whatever. And, if you want a car, you can test drive the car. Obviously, need attachments, need different things, but it's all doable. And we have rudimentary versions of it now. So give it 20 years and it won't be rudimentary anymore. 20 years ago, I'm just thinking like how games were 20 years ago. When I was a kid, 40 years ago, when I was a kid, games were green dots. Computer games were green dots. Castle Wolfenstein was considered a high-tech game. So Zuckerberg might be right, and he might be doing exactly what he needs to do to own the metaverse, to be the cornerstone of this new thing. He might be wrong, but you know what? Even if he's wrong and he wastes $40 billion, they got the money. It'll just be a mistake that they make along the road, but it won't stop them from making money again. They're not going, oh, not Facebook, it's Meta. It's not like he's borrowing the money. He's just spending the money they got. This is after the R&D. Okay, after the R&D, they're making $25 billion after the R&D. Okay, the company is being priced at $318 billion. They're making $25 billion, so it's 15 times earnings. All right, they project even less next year, but it's still not that bad. Still, I mean, that actually, I'm sorry, that's 15 times earnings. This is less than 15 times earnings. They got $30 billion in cash, net of debt. And that's with $10 billion of metaverse spending. So if he's wrong, they will eventually stop spending money on the metaverse and get back to business. If he's right, the metaverse will kick in another $20 billion in earnings, and this will be the most undervalued stock that ever happened. And I can't believe the crap people give this guy when he, you know, whether he stole it from the Winklevosses or whatever, he still developed and built and deployed Facebook. And he's obviously knows how to do this stuff. He knows how to roll out an entirely new social platform for people. And you could give him, like, you know, Elon Musk gets to do any bullshit he wants. Not starting to end, but, you know, Hyperloop and this and that. None of this crap works. Well, SpaceX works. So, you know, he just makes up shit and everybody jumps behind him and throws money at him. Zuckerberg, he has one thing that he thinks is really important and everybody treats it like it's crap. So anyway, I don't know. If you want to make 10 times your money, I think that's a good investment. That's all. I'm not gonna overpitch it. I don't want everyone coming after me, but I mean, I'm telling you, I don't see why this is such a bad thing. So that's a great trade. And honestly, if I didn't think he was maybe crazy, it would have been the trade of the year, but it's not the trade of the year because maybe he's wrong. Maybe he is wrong. But I don't think he's so wrong that this is a bad trade. But you see how that works? He's a great company. Netflix, also stupidly cheap. Paramount, we know I always, you know, think they're ridiculously cheap. Pfizer's another money machine. Just it's a thing that just spits out cash constantly. And it's coming back now, but I mean, when we were jumping in, it was a lot cheaper. So anyway, it's not for lack of having things to buy. And look how he hardly had to make any adjustments in the long-term portfolio because there are so many good positions. Look at Target. Oh my God, right? 9,000. All right, so it's 200,000. It's a $210,000 spread. It was a $12,000. Oh, that's so funny. It's a $12,000 credit. We spent $50,000, so now it's from a $12,000 credit. That means $28,000. Now it's $28,000 net on a 200. So another 10 times spread. 28,000. It'll be 210,000 if all goes well. And all goes well means we're targeting $200 on Target. That's our goal for Target. So, you know, don't tell me there's no money to be made. There's so much money to be made. And these are conservative plays with realistic targets. And if they get cheaper, that was the point I wanted to make. If the market goes down and these get cheaper, I want more. Why would I not want this trade? What is going to happen that's so horrible to the economy that I won't want that trade? Especially if I can reposition at a better price. All right. So contemplate that. use these portfolio reviews for a chance to augment your own portfolio. Look at all these fantastic positions. There's so many great things. $24,000, $150,000 spread. I mean, you know, don't just pick any random one, but you do the research and decide what you think is a good position and what's going to fit in your portfolio. But the opportunities are there for so many of these. And like I said, and we're hedged up the ass. That's also what makes it great. We have fantastic hedges and fantastic long positions. One of them is going to work out. So that's where we are. My voice is going. So thanks everybody for coming. Has Powell completely destroyed the world? No, he has not. Very good job, Jerry. Look at that, bouncing back. All right, now, I mean, none of it really means anything, but like I said, I don't expect much action between now and the end of the year. We'll check in next week and see if that prediction is holding up. All right, so thanks everybody for coming. I appreciate it. All right, take care, everybody.